With the Canadian economy slowing down, I want to invest in dividend stocks that can withstand a slowing economy or even a recession if that occurs. And one type of stock that jumps in my mind is supermarkets, because even during a recession, people still have to eat. I want to go over some of the largest and most popular supermarkets here in Canada. First, we got Loblaw, which is the largest grocery chain in Canada. They own popular supermarket chains such as the Real Canadian Superstore, Provigo and T&T Supermarket, just to name a few. Next we have is Metro, which is based in Ontario and Quebec, and is the third largest grocery chain in Canada. And lastly, we have Empire Company, which is engaged in both investments and supermarkets. They own the second largest grocery chain in Canada, Sobeys. I also want to take this moment to take a look at a few other retailers, Alimentation Couche-Tard, which is a convenience store, and Canadian Tire and Dollarama. First, as a disclaimer, I just want to say I'm not a financial advisor, so please do your own due diligence before investing. First, when we take a look at the numbers, you may notice something off. Metro's massive EPS for 2018, but that's mainly because they sold their holdings in Alimentation Couche-Tard, the convenience store we mentioned earlier, because they were raising funds for a drugstore chain they acquired for $4.5 billion. So if we were to factor that out of their EPS numbers, it will be closer to around $2.50. But overall, the three supermarket chains, they don't pay a very high dividend yield, and the two larger chains are already paying out a good chunk of their earnings. And on top of that, their PE ratio of Loblaw and Empire is very high. I also find Metro's PE ratio kinda high as well. Alimentation Couche-Tard and Dollarama just an abysmal dividend yield as well, and definitely does not grab my attention at all. Canadian Tire, on the other hand, does look decent, but of course they don't sell groceries. They sell things more like hardware, sporting goods, home products, auto parts, since they do have a car garage with every store. When we take a look at their stock performance, the two with the low dividend yields have performed very well over the years. Whether they can keep it going is another question, but the two largest supermarket chains have both ended up with similar performance, and Metro on the other hand has been performing pretty well. Their annualized return looks like it's all over the place, except for Metro, which is a little bit more consistent. But when we take a look at the chart, we can see a slightly clearer picture. First, I'm going to remove Alimentation Couche-Tard and Dollarama, so it'll be even clearer, and they pay an abysmal dividend yield anyways. First, you'll notice that Metro in the red has been pretty consistent in the past, but has slowed down in the recent several years. Loblaw in the blue, on the other hand, has been picking up their performance compared to their terrible performance in the past. And Empire in the green has just been trending downwards slowly over the years. And Canadian Tire has been performing badly in the recent 6 years as well. Next up, let's take a look at the revenue. First, you'll notice that Alimentation Couche-Tard's massive revenue growth over the years, but I'm pretty sure it's because of the high amount of acquisitions they have continued to make over the years. Loblaw has had a big jump on revenue in 2014 because of the Shoppers Drug Mart acquisition they made. We also see a decent uptick in 2014 for Empire as well, and that's probably due to their Safeway acquisition. But overall, they've all been slowly trending up. But now, looking at their yearly profits, at first glance, you'll notice some big spikes up and down, but there are reasons why. For Metro, in 2018 and 2013, they sold part of their holdings in the Alimentation Couche-Tard, which increased their earnings. For Loblaw, they sold their gas bar in 2017, and in 2014, they acquired Shoppers Drug Mart, which affected their earnings number. Also in 2006, they wrote down their assets because of the acquisition in Provigo back in 1998, hence why they reported a loss. Empire did the same in 2016 when they wrote down their assets, probably because of their Safeway acquisition. And in 2001, they had a big spike up in earnings because of some capital gains they made from investments. You gotta remember that Empire isn't just a supermarket, they also do investments as well, even to this day. If I modify some of these numbers a bit to remove the impact of some of these events, the chart looks more like this, and much easier and nicer to look at. First, you'll see a gradual trend upwards for Canadian Tire, Metro, and Dollarama. Nothing fancy, just slowly moving up. Alimentation Couche-Tard, on the other hand, has been wrapping up very quickly. I assume that's because of all the acquisitions they made. Empire has been slowly moving up, but had some trouble in the recent couple years after their Safeway acquisition. Loblaw has had some problems back in 2005 and 2006. Once they had that all sorted out, they were able to start growing their profits again. When we take a look at their profit margins, first thing you'll notice is the small profit margins there is with supermarkets. Loblaw and Empire has been hovering around the 2% range very consistently. Alimentation Couche-Tard, the convenience store, has had very low profit margins as well. Canadian Tire and Metro has been slowly increasing their profit margins over the years. It's very interesting to see how Metro is able to increase their profit margins over the years, where the other supermarket chains has been flat. Next up, when we take a look at their dividend, just take a look at Canadian Tire and how much they have grown their dividends over the past decade. they have really grown it by a lot. But of course, I can't continue to go on like this forever. But I feel they have a little bit more room to grow their dividends before they finally slow it down to something more reasonable. With Canadian Tire dwarfing all the other companies, let's zoom in a little bit to take a closer look at the other companies. First off, when you take a look at Loblaw, you see a period where they had no dividend growth. This was during the period where they had some trouble, and when they finally had that sorted out, they were able to start increasing their dividends a few years later. With Metro and Empire, since they've been able to slowly grow their profits over the years, they've also been able to slowly grow their dividends as well. And yes, Alimentation Couche-Tard and Dollarama has been able to grow their dividends over the years as well, but it's still an abysmal amount compared to their stock price. When we took a look at their dividend growth, we can see a gradual decrease in dividend growth with Metro and Empire. But the only thing is that Metro is still able to grow their dividends at over 10%, which I think is still very good. Loblaw, with their hiccup in 2005 and 2006, we see a gradual decrease in dividend growth, but since then, in the past 5 years, they've been able to slowly increase it again. And Canadian Tire, on the other hand, has been able to grow their dividends massively. Just look at those numbers in the 20 and 30% range. We can see this very clearly when we look at the chart. One interesting point is that even though Alimentation Couche-Tard and Dollarama pays a very low dividend already, they have really slowed down their dividend growth as well. So out of these supermarkets, which one do I like the best? Based on the numbers and performance, I prefer Metro, but unfortunately I never stepped into a Metro before since I don't live in Quebec and Ontario, but based on their numbers, they can still further grow their dividends some more, and they have higher profit margins as well compared to the other two. And on top of that, if they can integrate their new acquisition of the drugstore they just acquired into their business, they'll have even more room to grow, but we'll see how well they can integrate that. Also, if Loblaw has a decent pullback, I wouldn't mind starting a position in as well, because I feel with the growing private label market, it would help their profit margins. If you don't know what private labels are the brands that the supermarket comes out with, like President's Choice for Loblaw, Kirkland for Costco, because of course they'll be given shelf space at their supermarket, maybe even premium shelf locations, because why wouldn't you want to sell your own products where there's more profits to be made than the national brand? On top of that, I also like Canadian Tire as well. I feel they still have some room left to grow their dividends, and they'll be able to grow the company slowly over the years. And as always, if you enjoyed the video, please like and share the video. It really helps out the channel. If you haven't subscribed yet, please make sure to smash the subscribe button, and thank you for watching. I'll see you guys in the next video.